Advanced Audit and Assurance. Chapter 7. Planning. Contents. 1. The Audit Plan, that is strategy document. 2. Audit Risk. 3. Materiality. 4. Computers in Auditing. 5. Not-for-profit organizations. 6. Chapter Review. Introduction. Competencies. Accepting engagements and managing assignments. Analyze and evaluate the potential issues that determine the nature, scope, and extent of an assurance or audit engagement. Planning and undertaking work. A. Analyze, evaluate, and explain based on a business scenario the areas of a business that may be important to understand in order to develop an effective strategy or plan. B. Analyze and evaluate the techniques available to obtain an effective understanding. C. Evaluate and communicate the elements of audit risk, including inherent risk, control risk, and detection risk, and their relationship to audit planning of procedure. D. Identify and evaluate the components of risk for any assurance engagement. E. Evaluate and explain how business process effectiveness may affect an assignment. F. Identify and evaluate the risk arising in a business scenario from business and financial issues. H. Evaluate and apply judgments and measures of materiality in carrying out an audit or assurance engagement. I. Analyze and evaluate how risk and materiality judgment affect the planning of an assurance or audit engagement, including the nature, timing, and extent of work. K. Materiality decisions. I. Internal control assessment, including IT control. J. Identify and explain the differences between assurance engagement and audit engagement for profit and not-for-profit entities, including those in the public sector. K. Specify and explain in accordance with appropriate local legislation and international auditing and assurance standards the steps and procedures for audit and assurance work in the private and public sector. Assessment of risk, internal controls, internal financial controls. Identify and assess based on a given business and a given scenario the business, reporting, and compliance risk in the context of an assurance or audit engagement in the public or private sector. Explain the impact of information technology in an audit environment. Exam context. Planning is a fundamental phase of any audit and assurance engagement in Nigeria and other jurisdictions. This chapter expands on the basic introduction to planning that students studied previously and provides comprehensive notes on the audit plan, audit strategy, audit risk, and materiality. Given the ever-increasing relevance of computers to both practitioners and their clients in Nigeria and beyond, the chapter closes with a section on computers in auditing. By the end of this chapter, students will be able to describe how to plan an audit engagement, explain the various components of audit risk, discuss the principles and application of materiality, articulate the relevance of computers in auditing, describe and critically assess general and application computer controls. Subtopic 1. Audit Plan, Strategy documents. Section 1.1 ISA 200. Overall objectives of the independent auditor and the conduct of an audit in accordance with international standards on auditing. As you saw in your earlier studies, the objectives of the auditor per ISA 200 are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. This allows the auditor to give an opinion on whether the financial statements have been prepared in accordance with the applicable financial reporting framework. 2. To report on the financial statements and communicate as required by the ISAs in accordance with the auditor's findings. Where the auditor is unable to obtain reasonable assurance and a qualified opinion is insufficient, the auditor must disclaim an opinion or resign. The different types of opinions are covered in a later chapter. ISA 200 requires the auditor to 1. Comply with all ISAs relevant to the audit. 2. Comply with relevant technical requirements. 3. Plan and perform an audit with professional skepticism. 4. Exercise professional judgment in planning and performing an audit. 5. Obtain sufficient and appropriate audit evidence to allow him to obtain reasonable assurance. Section 1.2. The need for an audit plan, that is, strategy document. A plan is a course of action decided in advance to achieve a stated goal or objective. A plan is necessary for each audit so that the auditor can decide in advance what needs to be done so that by the required date for completion of the audit, he will be able to express an opinion on the truth and fairness of the financial statements and achieve the objectives of ISA 200. The extent and type of audit work performed is determined largely by the professional judgment of the auditor. The planning process enables the auditor to apply his judgment to the circumstances of the particular audit to decide how the audit will be conducted. A starting point for the audit plan is deciding which audit strategy to adopt. The auditor will need to consider, amongst other things, 1. Audit risk, including control risk. 2. Materiality. 3. The use he might make of computers and the effects that the client's computer-based system might have on his audit approach. These factors are described in the rest of this chapter. Section 1.3 ISA 300. Planning on audit of financial statements. The auditor's work on planning is regulated primarily by ISA 300, Planning and Audit of Financial Statements, which requires the auditor to plan the audit so that the audit work will be performed in an effective manner. An overall audit plan should be developed, detailing the expected scope of the audit and how the audit should be conducted. ISA 300 states that 1. An audit should be planned so that it is performed effectively. 2. The auditor should establish an overall audit strategy. And 3. The audit plan should include measures for the direction, supervision, and review of audit work. Section 1.4 Audit Strategy Memorandum. Most auditors prepare an audit strategy memorandum. This is a document setting out the main points involved in the planning process and the key planning decisions that have been taken. The memorandum will cover the following areas. 1. The assignment objectives and reports to be issued. 2. The audit timetable to meet the required reporting deadlines for the audit report. 3. Changes in the client's organization or business or external, that is environmental changes affecting the client's business since the previous audit. 4. A summary of key financial ratios and other ratios from previous years. 5. Planning decisions for the audit. 6. The use that will be made of the client's staff in the audit, for example, internal auditors, and the use that will be made of external experts. 7. Possible problem areas in the audit and the approach to be adopted to deal with them. 8. Staffing requirements for the audit. The planned allocation of the work between members of the audit team, time budget, and records from previous audits. 9. Attendance locations, if the client has more than one location. 10. Proposed method of communication with the client, for example, meeting or reports. The memorandum should be reviewed and approved by the audit engagement partner. Section 1.5. Information required to effectively plan an assignment. Information required to effectively plan an assignment. Relevant information. ISA 300, Planning on Audit of Financial Statements, requires the auditor to prepare an audit strategy and an audit plan. ISA 315, Identifying and assessing the risk of material misstatement through understanding the entity and its environment, requires that the auditor has sufficient understanding of the entity and its environment in order to understand the risk of material misstatement within the client's financial statement. In order to satisfy the requirements of both of these ISAs, the auditor will need to access a wide number of information sources. Remember that every assignment and client is different, so the auditor and you in the exam will need to use initiative and judgment in assessing relevant and reliable information to assist in the planning. Note 2 that during the planning phase, we are not yet performing the responses to the assessed risk of material misstatement, that is, the detailed audit test. This occurs at a later stage as directed by ISA 330, the auditor's response to assessed risk. So the auditor must balance efficiency and sufficiency during the planning phase to ensure they do not invest time in information and matters that are not relevant to the planning of an assignment. A common exam requirement involves a scenario that misses out some information that will be relevant to the auditor, either for planning or executing the audit. You may be asked to identify any additional information required. For example, 1. Obtain a copy of a new loan agreement with the bank to ensure that details of any overdraft limit and debt covenants are understood and whether any breaches have occurred. 2. Review legal correspondences between the client and its legal advisors regarding an incident that occurred during the year to establish the impact of the incident on the financial statement. Review details of any significant new sales contracts agreed with key clients. 4. Obtain a copy of prior year's financial statements in order to review the accounting policies used and any provisions and contingent liability recognized in the accounts relating to construction contracts, financial instruments, pension obligations, and legal cases. Non-relevant information. Remember that the objective of the audit is to identify whether material misstatements exist in the financial statement. Therefore, information relating to immaterial matters or operational matters that will not assist in concluding whether a material misstatement exists in the financial statement may not be relevant for audit planning. You will encounter other types of non-audit engagement in this syllabus, such as review, assurance engagement, compilations, and agreed upon procedures, where information not relevant to audit planning may still be relevant to other types of assignments. Subtopic 2. Audit risk. Section 2.1. Risk-based approach to auditing. A key feature of modern auditing is the risk-based approach that is taken in most audits. At the planning stage, as required by ISAs 300 and 315, the auditor will identify and assess the main risk associated with the business to be audited. The auditor will then design and implement appropriate responses to those assessed risks in accordance with ISA 330, the auditor's responses to assessed risk, including 1. Overall responses, 2. Audit procedures responsive to the assessed risk of material misstatements at the assertion level, that is, appropriate mix of test of control and or substantive procedures. Irrespective of the assessed risk of material misstatements, the auditor shall design and perform substantive procedures for each material class of transactions, account balance, and disclosure. The auditor shall also consider whether external confirmation procedures covered by ISA 505 external confirmations are to be performed as substantive audit procedures. The risk-based approach to auditing should enable the auditor to then conclude whether a true and fair view is presented by the financial statement. Section 2.2. The audit risk model. A standard audit risk model is available to help auditors to identify and quantify the main elements making up overall audit risk. Audit risk is the risk or chance that the auditor reaches an inappropriate or wrong conclusion on the area under audit. For example, if the audit risk is 5%, this means that the auditor accepts that there will be only a 5% risk that the audited item will be misstated in the financial statement, and a 95% chance that it is materially correct. The audit process is designed to give a high level of assurance about the information that is subject to audit. However, the audit process does not give an absolute level of assurance that the information is 100% correct. The implication of this is that the auditor will seek to reduce the level of audit risk to an acceptable level, but will not attempt to eliminate audit risk entirely. If the auditor is to manage risk effectively, he needs to be able to measure the risk attached to any given audit situation and establish a maximum acceptable limit to the audit risk. This leads to the development of the audit risk model. Audit risk is equal to internal risk multiplied by control risk, which forms the financial statement risk, then multiplied by detection risk, which is under the control of the auditor. So audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. Inherent risk and control risk are financial statement risk, but detection risk is under the control of the auditor. This model can be stated as a formula. AR, that is audit risk, is equal to IR, that is inherent risk, multiplied by CR, control risk, multiplied by DR, detection risk, where AR is equal to audit risk, IR is equal to inherent risk, CR is equal to control risk, and DR is equal to detection risk. Risks are expressed as proportions. So a risk of 10% would be included in the formula as 0.10. Section 2.3 Inherent Risk. Inherent risk is the risk that items may be misstated as a result of their inherent characteristics. Inherent risk may result from either 1. The nature of the items themselves. For example, estimated items are inherently risky because their measurement depends on an estimate rather than a precise measure. Or 2. The nature of the entity and the industry in which it operates. For example, a company in the construction industry operates in a volatile and high-risk environment, and items in its financial statement are more likely to be misstated than items in the financial statement of companies in a more low-risk environment, such as a manufacturer of food and drink. When inherent risk is high, this means that there is a high risk of misstatement of an item in the financial statement. Inherent risk operates independently of controls and therefore cannot be controlled. The auditor must accept that the risk exists and will not go away. The assessment of inherent risk. The auditor's assessment of inherent risk will be based mainly on 1. The knowledge gained from previous audits, and 2. An assessment of the current environment within which the entity operates. It is normal practice to assess inherent risk at 2 levels. 1. The financial statement level, and 2. The account balances and transaction levels. At the financial statement level, the auditor will consider the inherent risk in the client's business, such as the integrity, skills, and ability of the management, the nature of the business, industry-wide and macroeconomic factors. At the account balances and transaction levels, the auditor will consider 1. The degree of subjectivity involved in the account balance of the transaction, 2. The degree of complexity of a transaction and how it is processed, 3. The characteristics of the client's assets and the level of risk that they may be misappropriated. Example: inherent risk. It is difficult to provide a comprehensive list of inherent risk, but you may be required to identify one or more such risks within a case study type of examination question. For example, suppose that the CEO of an audit client company is also a majority shareholder of the company, and you are aware that he intends to sell some of his shares soon after the financial statements are approved and issued. In this situation, there would be an inherent risk at the financial statement level, arising from the fact that the CEO, the majority shareholder, has a personal interest in presenting favorable financial statements. The reported profit for the year or the reported statement of financial position, and may therefore have deliberately window-dressed or misstated the draft financial statement.